Cheers. Thank you, everyone. It's nice to be back here today. I really enjoy seeing so many of our clients present. My presentation will be the shortest of the four. I'm really just going to talk a little bit about the asset allocation positioning of our multi-asset solution funds. The audience today consists mainly of financial advisors and some direct investors into our unit trust vehicles. So we're looking particularly at the unit trust portfolios. So just to remind you, we run a pretty sort of small range of products. It's not a wide range of portfolio options. In the South African or the local fund space, if you look at that risk-return profile, from the sort of a low-risk fixed interest side that Sandile spoke about, all the way to the more aggressive equity-type funds that Johnny presented on. And I'm going to talk a little bit just about the Inflation Plus Fund and the Balance Fund, which are the so-called solution multi-asset funds. I just thought it's interesting because we tend to show these sort of graphs on an efficient frontier risk versus prospective returns. So we've added here in red the last 3-year performance of the various funds, net of fees. So it's the completely net of cost returns. And it is interesting to see that over this period, the performance of the funds have basically held up to that risk-return profile. So the more conservative funds in the money market space, for example, doing 5 to 8%, inflation plus 15.5 per annum, balance fund 19, and then the equity funds at the far right doing about 20, 21% per annum. So it has held up in that traditional sort of space. I should caution that those absolute returns on the right-hand side, and I think we say this every year, are very high. In a real sense, it is most unlikely that we'll have the sort of returns over the next 3 years. We also run a range of international funds, which are our rand-denominated offshore portfolios. A global high-yield bond fund, I think it's well known. It's an industry-leading fund. And then maybe a new vehicle for you that you might not all be aware of is our global cautious managed fund. We amended this fund. It used to be effectively an enhanced cash vehicle. We changed our fund prospectus a few years ago in order to effectively replicate an international version of the Inflation Plus Fund. We unfortunately had to wait for the FSB to publish Board Notice 92 that allowed us the flexibility to implement certain of the trades that we wanted, and that effectively took place about the start of 2014. So the long-term performance of the fund is a bit misleading. The current structure is what we intended to be. So we have high expectations of this vehicle, and if you do need to get more information, please talk to any of the Prudential staff about the fund. And then obviously on the right, Global Value, which is our equity fund of funds, which did about 30% per annum. Okay, so Sandile didn't lie. This is a slide that we often use in our client presentations. It's in many ways our initial screen of value when we look at asset classes in terms of what might appear to be cheap for us. I'm not going to go through the details. Sandile covered that in quite a bit of detail. But just to reiterate or to point out that two issues. Firstly, you can see the yields on offer at the moment, which are the red bars. That's what we can get from the market if we buy the asset class today. All of them are at or below the long-run fair value. It's not an exact science, so it is a broad grey area, but none of these assets are screamingly cheap. We are struggling to find cheap assets. That's maybe the short summary. Potentially within corporate bonds, it doesn't look too bad, but equities, property, cash, inflation linkers are all trading at pretty stretched valuations. However, at the same time, we can see that line or that graph is still upward sloping. So fortunately, because it does get very difficult otherwise, that risk-return relationship is holding up. We are getting paid more for taking on that risk. So it's a bit of a challenge for us then. So on the right, equities are expensive by this account, and yet relative to the other asset classes, it is the asset class that is posed to deliver the highest real return still. So that is a bit of a mixed signal that our team needs to maneuver through. So I'm going to touch very briefly on each of the asset classes and just highlight a few points. So this is the equity index over time, goes back to 2002, all-share index in red. and the forward earnings per share, profits per share of the index in grey. I think it's grey. And as you can see, the market is not particularly crazy. Equity pricing does follow profitability. So as earnings rise, the equity market tends to follow that. Just to highlight, we've plotted earnings per share on a 12.5 multiple, which is the long-run average PE of the all-share index. Or to think about it differently, whenever the grey line and the red line crosses, the market is trading on a 12.5 forward PE. As you can see at the moment, the market is trading well ahead of that earnings line. So the latest rally for probably the last year or two has been driven principally by a ratings expansion. So the market has become more expensive, and it hasn't been supported by growth in earnings. And very recently, in fact, earnings have trended down a bit, and that gives us some cause for concern. So the market is now, in our view, probably 10-15% overvalued, and we do need to see corporate earnings rising to justify the current level of the market. It doesn't mean to say that you will have a market correction. It could just be that the market could go sideways with some volatility, waiting for earnings to effectively catch up. Earnings is a challenging thing to forecast, obviously, so another way to look at the equity market, which doesn't include an earnings forecast, is to look at price to book. It's the price versus call it the net asset value of corporate South Africa, as determined by the accountants. That's in red on this graph. South Africa is interesting. Our price to book series, going back to 1980, has been mean reverting around an average of 2.2. And as you can see here, we have for the last 3-4 years been trading very much range bound around that 2.2 level. So on a price to book measure, the market has not appeared to be overly expensive nor cheap. Just recently, though, you can see it has jumped up a bit. So it's probably, again, 10%, I guess, overvalued on this measure. Just to highlight the gold line, which is the world price to book series, that traded very cheaply for the last 4 years or so, and we've been overweight global equities as a result. And in this year-to-date rally has also closed and is now arguably sort of on fair value as well. But we still do prefer global equities over South African equities. So in our multi-asset funds, where we have the ability to hold international assets, we've taken more of our exposure into global equities. Property, Sandile spoke. I'll just highlight one chart on that. So this is just the property forward distribution yield, basically the distributions paid by listed property companies relative to other similar assets broadly. So versus cash, inflation-linked bonds, and the 10-year government bond, the various yield differentials. And as you can see, lately, in this rally, and property has been an extraordinary asset class. We do like the asset, but it has rallied very hard. And you can see how that yield differential has narrowed against all three measures, particularly against cash. And in this rally, we have recently reduced our property exposure into cash in our portfolios. And then the most difficult of all assets, obviously, the exchange rate. We often say that we have really no ability to predict what the currencies can do. It is a very, very difficult thing. This is one measure we do like to track. It's the real effective exchange rate. It's basically a real index of the rand versus its trading partners. And we've got an average line here from 94, when the economy opened effectively. And you can see at the moment the rand is clearly quite cheap. The only caveat I can say is that currencies have this unfortunate ability to trade away from fair value for long periods of time. And you can see, for example, the rand traded cheaply for about 4 years in that space there. This would indicate that one would bring back your offshore assets and buy the cheap rand. We haven't done that. We still hold our maximum. We do think that this could continue for a while. And secondly, strategically, we'd probably like to hold a much higher offshore exposure in the region of 30 to 35%, and being capped at 25 sort of forces you to really, you hit that ceiling constantly. So it has to be an exceptional cheap rand for us to really bring back the money to below the 25% level. We do produce a global version of that earnings slide that just looks at and this is done by our colleagues in London. It looks at the yields on offer in these bars for cash and fixed interest on the left and equity markets on the right, relative to, again, a similar measure of long-run fair value. And just to highlight that globally, we're still in this environment of low rates, where central banks are doing whatever they can to maintain low fixed interest and cash rates to stimulate economic growth. And as results, generally, these assets are not particularly attractive. They are trading at sometimes even negative real yields at this point. There is opportunity still in equity markets. None of them are particularly cheap. Russia is an interesting, maybe a difference there. But none of them are very expensive, barring perhaps South Africa. And I think that's Taiwan on that bar. But we like Europe. You will see Italy, Germany trading at fair value or slightly cheap from fair value. So we still have overweight positions in some of those markets. Which leads us to the portfolio positioning. So I've plotted the inflation plus fund in red and the balance fund in grey. And I've chosen to do it in this way just to highlight the difference in risk profile of the two funds. So as you would expect, the balance fund is a more aggressive fund. It targets longer term growth, higher real returns, and therefore by its nature will hold a bigger exposure in, call it risky assets, real growth assets such as equity and listed property. It does, about 40% now in SA equity, 2% in property and so forth. You will note that our cash weight here is risen. For us, that's an uncomfortable position. We, as a long-run growth portfolio, you would not expect us to hold 22% in cash. It really just reflects the profits that we've taken out of inflation linkers, the listed property market and the equity market. The Inflation Plus Fund, a more conservative fund, much more diversified, holds lower growth exposure, so less equities, as example, and more inflation-linked bonds and nominal bonds, now down at 6.4% in property, and also a little bit less in international equities. So, I mean, hopefully the picture is quite clear in terms of how those two funds would be positioned from a risk-return profile, noting that our, call it active positions relative to our long-run benchmarks would be applied consistently across the two. This is the long-run internal strategic asset allocation that really varies between the two products. And then one slide on our Global Cautious Managed Fund. I spoke about that earlier. So this is the current positioning. It's all international. The grey boxes reflect the ranges within which we can move the asset allocation as allowed by the prospectus. And the red lines show the current positioning. So you'll see we overweight, or we prefer still some foreign equities, property, international property, and this is US and global ETFs tracking the REIT indices that we've bought here. We are underweight foreign bonds. Because of that previous graph, we're not really getting a very attractive yield on global fixed interest assets. And then sort of moderate in cash, quite similar argument. We'd like to deploy the cash into growth assets if we get the opportunity to do so. Right, and then in conclusion, and I did say mine was the shortest presentation. Just to conclude, we now have 5 of our unit trust funds that have a 10-year or longer track record, and very pleasing, all 5 of those funds are in the top quartile of their various ASISA peer categories relative to our competitors. And I've listed them here, and you can see the annualized performance per fund versus the average peer group and our outperformance per annum. So very pleased by that. We remain humbled by the support that you as clients give us, and we commit to continue doing what we've done over this 10-year period.